So in this talk, I will give a brief introduction to Solvency II. As a topic and a practice area, it is vast. It was many years in development, preparation, consultation, implementation, and amendments to make it a better fit for its purpose. And it's still the subject of consultation and review today. Today, I'll only scratch the surface. If you're familiar with Solvency II, this talk can be a one-stop refresher of the building blocks. If this is your first Solvency II talk, then I hope that you'll have a better outcome than me when I attended my first Solvency II talk. That was back in 2007, and I did not understand anything. A good outcome for today would be for you to understand and describe the core of Solvency II. Right. So let's start. Our agenda for today, I'll give an overview of the solvency regime and its structure. I'll then briefly cover each pillar of the structure. Pillar 1 covers quantitative requirements. Pillar 2 covers requirements for governance and supervision. And Pillar 3 touches on both requirements and how they're communicated through regulatory reporting and disclosure. Finally, I will give a one-slide recap and we'll have time for questions at the end of the session. Can everyone hear me well so far?
Yes, perfectly.
Excellent. Okay, so our overview. What is Solvency II? Solvency II is a harmonized prudential regulatory framework for the supervision of insurance and reinsurance companies operating in the European Union. It's a risk-based regulation. It goes beyond quantitative measures, such as capital requirements, and covers overall management of a company's risk. It applies to all EU insurers and reinsurers, except for those with annual premium income below 5 million euro and technical provisions less than 25 million euro. But these companies can still choose to be regulated by Solvency II if they wish. It came into effect on the 1st of January, 2016. It replaced 14 directives, commonly known as Solvency I, where capital requirements were determined using a factor-based approach based on metrics such as technical provisions and premiums. Solvency II is not a zero failure regime. What that means is that whilst the capital requirements reflecting the risks to the company and the governance managing those risks minimizes the impact of severe conditions, it is not possible to foresee and cover all future events. A solvency regime should be such that an insurance company can withstand extreme events while maintaining its ability to pay its liabilities. Insurance business is long-term and it faces a number of risks by virtue of the business itself and the decisions that the company makes to continue to honor its obligations while still making profit. So if we revisit the definition to understand the main aims of Solvency II, it is a risk-based regulation. When companies' solvency capital is sensitive to its risk profile, this gives an enhanced level of protection to policyholders. Risk-based also means that the higher your risk exposure, the higher your capital requirements. So this gives an incentive to have more effective risk management in place to reduce the risk and the capital requirements that the company holds. A harmonized regime across the European market also meant that companies would determine their capital requirements in a similar consistent approach and can reduce regulatory arbitrage. For example, being selective within the rules and structuring your activities in a way that can reduce your capital requirements without actually reducing your risk. This integration of the EU insurance market also meant that supervisors, market players, and consumers can have a comparable view of the market, protecting the market and giving more confidence in its stability. So with these aims in mind, how does Solvency II do that? Solvency II has a three-pillar structure, similar to Basel II. The first pillar deals with quantifiable risks, the principles of valuing assets, valuing liabilities, and determining capital requirements over a short term. Pillar 2, the governance and supervision, emphasizes the systems of governance and risk management with an additional layer of risk assessment that considers quantifiable and non-quantifiable risks over the medium and long term of a company's operation in what is called an own risk solvency assessment. So that's an ORSA. And it introduces supervisory powers to enforce remedial action if the supervisor deems that a company is not sufficiently capitalized to its level of risk. Then we have Pillar 3, which tackles how the outcome of the first two pillars should be communicated in a consistent and comparable and transparent way, and who needs to know what. So we'll have two audience participation questions here. The first question, Solvency II came into force on the 1st of January 2016, but when was the Solvency II directive approved by the European Parliament? Is it 2014, 2009, or 2001? So the correct answer is 2009. 60% of you got this right. However, these three dates are important for Solvency II. 2001 is when the process was started of assessing the existing insurance regulation, and the Solvency II process was launched. 2009 was when the directive was issued, and 2014 is a year where an amendment to the directive was made. So they're all important dates. We have a second audience participation question. How much did it cost UK insurers to implement Solvency II by the date it came into force, the 1st of January 2016? Is it 500 million pounds, 1.5 billion, or 3 billion? So the correct answer is 3 billion. It is quite an expensive regulation. And remember, 3 billion is only what cost insurance companies in the UK. It cost much more across the whole of the European Union. So Solvency II took a long time to implement. It cost a lot of money. But also remember, a lot happened since the process was launched. We had a financial crisis. There was the European sovereign debt crisis. There were very low interest rates, and we had Brexit. So there was a lot happening, and companies worked quite hard to get to the point of implementation. So the stages of development take time, and they require thorough consideration, impact assessment, and significant development and consultation. There are many stakeholders. So I will cover this very briefly. The Solvency II stages of development follow something called the Lamfalussy process. It is named after Alexander Lamfalussy, who was the chair of the EU Advisory Committee that created the process. I will not cover this in detail, but in a nutshell, there are 4 levels. A framework with generic rules is developed in level 1. It's directed at the member states, and it is transposed into national law. Then there's level 2, which elaborates level 1 and is legally binding. Technically, we should move to level 3, which is the guidelines, which are directed at national supervisory authorities, so that would be the regulators, and it ensures consistent implementation across the member states. It is not legally binding, but on a comply or explain basis. What that means is the regulator needs to either comply with the guidelines or explain why they are not going to comply. But you'll find that there is an additional level 2.5, that was not part of the original Lamfalussy process. However, this is a result of what is called a Lisbon Treaty, which introduced institutions and gave them powers. So for example, EIOPA, the European Insurance and Occupational Pensions Authority, replaced CEOPS, which was a committee. And it also introduced public consultations and cost-benefit analysis. And then finally, level 4 is the enforcement. For Solvency II, level 1 started in 2009, where the directive was approved, and it ended in 2016 when it came into force. So it sounds like a lot of work. Let's cover the starting point for companies. This is a picture that we are going to revisit a number of times during this part of the presentation. This is the Solvency II balance sheet. Pillar 1, which quantifies the quantitative requirements of the regulation, is based on a total balance sheet approach. So the impact on the total balance sheet of a risk materializing in an extreme condition represents the capital needed to be held against that risk. It doesn't just cover insurance risks, it covers quantifiable asset and liability risks and how they interact. It uses market consistent valuation. This is important because compared to the previous regimes, prudent valuations were used for liabilities, and different companies could use different ways of valuing their assets. So let's consider each one of these building blocks. Our first building block is technical provisions. The definition of technical provisions here is that it is the sum of best estimate liabilities and a risk margin. Best estimate liabilities is a probability weight average of future cash flows, taking account of the time value of money using the relevant risk-free interest rate term structure. So cash flow projections take account of all the in and outflows required over the lifetime of the insurance obligations, and the probability of these cash flows happening are considered. Then they are discounted using a common central interest rate term structure that is also specific to the relative territory. This is different to previous approaches where, say, the discount rate would be determined by considering the assets held against the business and their future expected returns. Now, these cash flows are calculated gross of reinsurance recoverables. These are now considered an asset in Solvency II. The cash flows take account of financial guarantees, contractual options, policyholder behavior, future discretionary bonuses, and future management actions. Management actions are particularly important for with-profits business, where management can take action in certain circumstances, such as cutting bonus rates, for example, when there are adverse conditions. So this is the best estimates of liability part. Now let's talk about the risk margin. The risk margin is the cost of holding capital in the future in respect of non-hedgeable risks over the lifetime of the existing contracts. And that is 6% of the expected capital requirements in the future, discounted to the balance sheet date. So in other words, it is the cost of providing an amount equal to the capital requirements necessary to support the current insurance and reinsurance obligations over their lifetime. This requires a projection of future capital requirements. It also represents the potential costs of transferring the obligations to another insurance company immediately. The best estimate plus the risk margin, that's technical provisions. But what if your liability cash flows replicate those of financial instruments? We have an exception here where future cash flows associated with, say, insurance and reinsurance obligations, a certain portfolio of risks and contracts, can be replicated reliably using financial instruments for which a reliable market value is observable, as in they can be hedged, then the value of the technical provisions associated with these cash flows can be determined on the basis of the market value of those financial instruments. In this case, a separate calculation of the best estimate and risk margin is not needed. So if we revisit the Solvency II balance sheet again, we have block number 1, our best estimate of liabilities for non-hedgeable risks. So these that we don't have a financial instrument that can replicate its cash flows. 2, the market consistent valuation for hedgeable risks. And 3, a risk margin for the non-hedgeable risks. And of course, we have the assets for the assets covering technical provisions valued on a market consistent basis. Another block of the capital of the balance sheet, insurance companies need to calculate capital requirements. The solvency capital requirement, or SCR, this is a very important term to remember by the end of this presentation and going forward. It is the main outcome of Pillar 1. The solvency capital requirement, SCR, and the minimum capital requirement, the MCR. So what are they? The solvency capital requirement is a value at risk measure at a 99.5th confidence interval over a 1-year time horizon. What that means is a company can withstand the worst annual loss expected over the next 200 years. Or in other words, if an extreme market or extreme conditions materialize, the probability that a company will become insolvent is less than 0.5%. Or in other words, what we're saying is, we want the company to be able to withstand an event so extreme, we'd expect it to happen only once in 200 years. So these are 3 different ways to express the SCR. It can be calculated using a prescribed approach called the standard formula, or a company-specific model that would be called an internal model. It has to be approved by the relevant regulator and meet certain standards in order for a company to use it, or a combination of both, and that would be called a partial internal model. This is where a company can use a standard formula approach for some of its risks, but considers that other risks would be better measured using a model other than the standard formula. Also, this needs to be approved by the regulator. Breaching the SCR, as in not having enough capital that meets the SCR, is the first point of supervisory intervention. It leads to increased supervision, but companies can continue to operate subject to recovery measures in a short period of time. So this is our solvency capital requirement. The minimum capital requirement is a much simpler metric. It's factor-based, it's a linear formula. It's not an addition to the SCR, but a subset of the SCR. If we're saying that the SCR is a value at risk at 99.5% confidence, then the MCR is at the 85% confidence interval. It has a floor and a cap. So the MCR cannot be less than 25% of the SCR, but also cannot be more than 45% of the SCR. And both are subject to a monetary value minimum. In 2016, when Solvency II came into effect, this monetary minimum was 3.7 million euros. The MCR is the ultimate point of supervisory intervention, below which the company would lose its authorization to sell business. The capital requirements, the solvency capital requirement, has to cover non-life underwriting risk, life underwriting risk, health underwriting risk, market risk, counterparty risk, and operational risk. So now we have our technical provisions representing a realistic estimate of your liabilities, and capital requirements providing a buffer against extreme events. We have assets covering the technical provisions, but the company has other assets too. In fact, it has to have assets to cover its capital requirements. So let's look at the term own funds. Own funds are assets in excess of technical provisions. They cover the capital requirements and include any surplus above the SCR. It's split into basic and ancillary own funds. Basic own funds is capital that already exists within the insurer. They are tiered based on quality of capital. Tier 1 is the highest quality and Tier 3 is the lowest quality. There are requirements of what can be used to back the capital requirements. So for example, the SCR has to have at least 50% backed by Tier 1 own funds and less than 15% Tier 3. The MCR has to be backed by at least 80% of it being backed by Tier 1 own funds and no Tier 3. Remember, the MCR is a level below which an unacceptable risk is present for policyholders. It should be good quality assets. Ancillary own funds, they are off-balance sheet items. It's capital that can be called upon in certain adverse circumstances, but which do not currently exist within the insurer. For example, unpaid shared capital. When there are adverse conditions, the management could call on these to be paid and therefore support the business. So how does all of this interact? We have our Solvency II balance sheet here. The structure of risk coverage, let's consider the standard formula because it is a standard. The standard formula is a standard prescribed set of stress tests or factors, which are then aggregated using prescribed correlation matrices. There are a number of risk modules that are prescribed within the standard formula, the Solvency II regulation. So we have market, health, life, non-life, and so on. Each one of these modules have submodules. So if we look at life, you have mortality risk, longevity risk, disability, morbidity, lapse, expenses, catastrophe, and so on. Let's consider how solvency capital can be calculated in a very simplistic way. Let's look at market risk in this instance. In market risk, consider equity. So if the calibration of what a 1 in 200 adverse equity event i.e. the 99.5th worst possible outcome, for example, is a 20% drop in equity values. And you stress your equity portfolio. The change in the net asset value, so the change in your assets, minus the change of your liabilities that happen because of a drop in 20% in equity values, that would be your capital requirement for equity. The same is done for each submodule of market risk. But the capital requirement for market risk isn't a simple sum of the capital requirements of these submodules. This is because risks interact. So when equity goes down, it might have a positive or negative correlation with the impact on another risk. But you also wouldn't expect all your submodules to be subject to severe conditions at the same time. So a correlation matrix is used to aggregate the capital requirements of all of these submodules to arrive at the capital requirement for market risk. And in a similar manner, market risks and the other modules are then aggregated using a different correlation matrix. For the same reason, it recognizes that these risks would interact. They could have negative or positive correlations, and we also don't expect them all to happen at the same time. And this is the basic main idea behind how capital requirements is calculated. It is, of course, more complex for internal models. Now, this concludes the basics of Pillar 1. You would be pleased to know that this was the most dense part of the presentation, and the rest should be simpler. So now we have a measure of how much capital to hold to protect the company against its quantifiable risks. What's next? We have Pillar 2, governance and supervision. At a glance, Pillar 2 introduces formal governance requirements. It assigns overall responsibility for ongoing compliance with Solvency II to the board, and their involvement must be demonstrated. It also specified roles and responsibilities and introduced key functions within the business: internal audit function, risk management function, actuarial function, compliance, and internal controls. There must be clear segregation of responsibilities and duties in the structure chart of the organization. And it also introduced requirements for the individuals carrying out these functions to be fit and proper, the right person at the right place with the right qualification and the appropriate repute, for example. Pillar 2 recognizes that effective risk management should also link to the company strategy. It is not just constrained to what you can quantify today of the risks that you are facing today because of the business that you are holding today. So it is future looking. And all of this is considered in something else called the ORSA, the Own Risk and Solvency Assessment. Now let's look at the ORSA at a high level. Whilst ORSA is, in a way, a report, the definition for it is larger than that. It is the entirety of the processes and procedures employed to identify, assess, monitor, manage, and report the short and long-term risks that an insurance undertaking or company faces or may face, and to determine the own funds necessary to ensure that the undertaking's overall solvency needs are met at all times. So what does that mean? The ORSA process looks at quantitative risks. So we've looked at quantitative risks at Pillar 1, but the value at risk confidence level for Pillar 2 doesn't have to be 99.5%, like the SCR. It could be internally defined and would link to things like the risk appetite of the company, for example. It also looks at qualitative risks that are not included in Pillar 1, such as, for example, reputation risk. Some risks are better managed by governance than they are by holding capital against them, and Pillar 2 recognizes that. The ORSA also assesses the ability to continue to meet the SCR of the company in the future. The time horizon of assessment is different as well. For Pillar 1, the SCR has a 1-year time horizon. In Pillar 2, the ORSA has a time horizon that extends to the business planning period of a company. It also allows for new business that the company would expect to sell in the future, whereas Pillar 1 only covers existing business. The supervisor may determine, based on the ORSA and the Pillar 2 measures, that additional capital requirements are needed if the ORSA shows that levels of capital may not be adequate. Remember, this isn't just numbers like Pillar 1, but management and controls of risk as well. And speaking of management, there must be evidence produced to show that senior management is involved in making strategic decisions, and they are using the internal model and the risk assessment in making these strategic decisions. So these are the key concepts of Pillar 2. So now we covered financial requirements, future-looking risk assessments. Now what? Pillar 3 covers 2 types of reporting: private reporting to the regulator and public disclosure. At a glance, Pillar 2 is meant to aid supervision and increase transparency by ensuring that there are consistent, comparable, clear, and accessible information to the regulator and to the public. It has increased the scope and granularity of information that insurance companies were reporting pre-Solvency II. There's also a higher frequency of reporting with a decreased timescale for reporting it, so it is quite challenging. The quantitative financial and solvency results are reported in standardized templates. The qualitative information and supporting narratives cover prescribed topic areas. Publicly disclosed events is a subset of the privately reported the privately reported information to the regulator. And that's because certain business sensitive information is not appropriate for public consumption. So let's start by looking at some of the quantitative templates. There are a number of quantitative templates. There are tens of them. Actually, I think when Solvency II was still coming into force, there was something close to 90 quantitative reporting templates. Not all of them would apply to every company. But the most important template type that you'll need to remember is what is called a quantitative reporting template, or QRT. Now, these would have detailed financial and solvency information. They cover things like balance sheet, assets and liabilities, premiums, claims, expenses, own funds, technical provisions, solvency and minimum capital requirements, and variation analysis, and reinsurance programs. They aid the review by the regulator, allows for consistent comparison across entities and across countries. There are annual QRTs and quarterly QRTs. The quarterly submissions cover a subset of the scope and level of detail of the annual submissions. They apply to individual companies and to group reporting. I'll cover two more types of templates. Let's look at the financial stability templates. These have key financial and solvency information for macro financial stability monitoring. These were submitted to the European Central Bank. They cover some of the QRTs and other items such as profit and loss and duration of liabilities, among others. They're only required at group level with input from the solo entities of the group. They're similar to the QRTs in that they have annual and quarterly reporting. And then there are national specific templates. These also contain key financial solvency information, but they are for the purposes of micro financial stability monitoring. These are required by the regulator of the individual countries, otherwise called NCAs or National Competent Authorities. The required information is determined by the relevant national authority. These are reported on an annual basis. So this is where the numbers go. We have two key reports. As I mentioned earlier, we have a regular supervisory report, and this would be private disclosure to the regulator. And then we have public disclosure to the public in a report called Solvency and Financial Conditional Report, or SFCR. You can find SFCR reports for European insurers on their websites. I'd recommend reading one of them. They are published annually. The RSR, or the regulatory report, is required to be published every 3 years. However, a regulator may require it annually, or may maintain that it's submitted every 3 years with annual update, talking about any significant changes. There is an overlap between the two reports, and that would be this area here, a description of business and performance, systems of governance, the risk profile of the company, regulatory balance sheet, capital management, some of the QRTs, that's the quantitative reporting templates, and the ORSA process. There is then incremental information, which is submitted to the regulator and not made available to the public. And these would be business and risk strategies, financial and non-financial objectives, an explanation of variances against plan compared with the prior period, legal and regulatory issues, future anticipated solvency needs, any additional internal model information or additional risk profile information, say the results of exercises of stress testing and sensitivity analysis, which is not appropriate for publication. Also, competitors should not be seeing that information. It will have all the quantitative reporting templates, and it will also have the ORSA results. So this is Pillar 3 in a nutshell. Now we will have a one-slide recap. And just remember, Solvency II is a truly vast topic, and each area that we have covered today can warrant many, many sessions to give them a fair representation. But if we recap and go back to the original definition I used in slide 1, Solvency II being a harmonized prudential regulatory framework for the supervision of insurance and reinsurance companies operating in the European Union. It's a risk-based regulation, goes beyond quantitative measures to cover overall risk management. So we look at Pillar 1, which gives risk-sensitive capital requirements for quantifiable risks. This is then complemented by better risk management, governance, and the assessment of quantifiable and non-quantifiable risks in Pillar 2. And then there's a consistent and comparable reporting with risk dialogues, which enhance transparency, and that's Pillar 3. And that is the cycle of Solvency II and how it is a harmonized and prudential risk-sensitive regime for the assessment of the solvency of a company. And that you have made it to the end of the session, which is great. I hope that you found it useful, and feel free to ask questions if you have any. If you'd also like, you can reach out either through Alia or to me directly on LinkedIn, and I'll be happy to direct you to any resources which might be of use.